Hi, welcome to the mid-October weekly market update. A lot to cover, a lot of really exciting, interesting news. First of all, we're going to be talking about the slowdown in contracts signed this past week. What does that mean? We're going to be taking a quick sneak peek at the 7 luxury sales that happened this past week as well. I'm going to take you on a 200-year view of what's happened with rates because I think context is really important. And then we're going to talk briefly about the inverted yield curve, which is a prediction of the last 10 recessions. Let's quickly dive in over here. I'm excited to share this with you. So first off, let's talk about the market here in New York City. Number one, supply is at 7,689, and the number of properties in contract is at 2,761. On a weekly basis, what we care about is that 350 properties got listed for sale this past week, and there's nothing really notable there. That's normal. That's what's happened in the past. We're on a regular curve. But contracts signed only came in at 145 signed this past week. And that is something we should be talking about because when we look at historically, we find that we should be having more contracts signed at this point in time. We generally like in October and November is a busy season for us. We generally like to have around 900 contracts signed a month. And at around 150 right now, that takes us to 600 in the month. So we're going to have to see how the next week come about, but that's definitely a signal that we're paying attention to. And when I see a divergence from historical norms, I take a deeper look and I look at the negotiability. How much are sellers having to negotiate to get a deal done? And how has that changed over the last couple of years? And this red line over here, it shows you the percent of properties that had larger than a 10% discount, right? That means the market's not doing very well. People are negotiating a lot. And so, of course, during COVID, people negotiated more than 10% to get a deal done. If you were, if a buyer was lucky enough to buy, then there were so few sales. But that completely changed last year. You see this change over here. And as we know, for the last 19 months, we've had a fantastic, high volume, great, amazing market, and very few properties negotiated more than 10%. But what you'll see is coming up to July, we start to see this go up again. We start to see more properties negotiating more than 10%. And we also see less properties getting a deal done at under 2%. Now, we have to go back to July because by the time all the final records get to the courthouse and get to the public, it takes a few months. But we are kind of seeing this happen. And this is something, once again, we're going to keep a close eye on. Now, let's take a quick peek at the luxury market because we had 7 sales that took place this past week. And if we want to look at it, that the discount to get those deals done were only 2%, which is quite interesting when looking at the luxury market. We like to see more than 7 sales at this time of year, so it's a little bit sluggish, but at the same time, interesting to see it wasn't as high of a discount. If you want to take a look, you can take a look at some of the details of the sales in the condo and the co-op market, as it's interesting. What I want to jump into right now is I want to talk about rates because right now, rates, they're above 3%. And I'm talking about the federal funds rate. And on this chart, something that's very interesting is when this chart was created, it was at 3.8% here in October now. And people talk about how rates are really high. And what does that mean? Because when you look at over the last 40 years, it does not look high. I mean, they were at 15.8%, obviously, at one point. It is not really high. So why is there so much talk going on? And if we take a look at even larger picture at the last 200 years, right? Well, again, this 3%, this is definitely not considered high, right? So why are people talking so much about the rates? Well, what people are talking about is how much the rates have gone up so quickly, 0.75 basis points in September, July, and June. See how much they've gone. And the real notable thing over here is that when we look at it, the rates have gone up around 2.36. That's how much federal funds rate has gone up. Now, it's gone up a lot more. I mean, in 05, 06, 04, 06, it went up 4 percentage points. But here it went up in 6 months. It is rising faster than any other time in recent history. That is what people are really concerned with. And if we take a look even further at this, we're going to find that it was 6 months, as I said, to go up 2.36. It went up back in 15 to 18, 2%, but that was over 36 months. So as you can see, this is what people are paying quick attention to. Now, I hear a lot in the news, people talking about a recession, either we're in a recession or we're getting to a recession. And you'll hear people talking about something called the inverted yield, the inverted treasury yield. And what they're talking about over here, the inverted yield curve, is that um, the short-term treasuries have a higher yield than long-term treasuries. That means people are more confident buying longer-term treasuries. There's more people that want it, and so there's demand for it, and there's not as much demand for short-term treasuries. Why is that? Well, I mean, if the federal government is raising interest rates because they want to slow down the economy, they want to put the brakes on economy, on business, on employment, well, then obviously investors are going to be concerned over the short term. They're going to think maybe the short term isn't a great investment. But again, once the federal government fixes things and gets inflation under control, long term, of course, things are going to be great. It's America, so on and so forth. So it's a very interesting thing to take a look at that and pay attention. And now when you hear about the treasury yield curve inversions, you'll have an idea of what it is that they're talking about. Now, I want to give you some quick takeaways over here. First of all, if you're a buyer and you're looking to purchase property, you should be on that. You should be really aggressively out there looking to purchase property, in my opinion, because right now you have that ability to negotiate more than you normally do. You could take a little bit longer to purchase property, and that's really in your favor. I would caution you, though, not to try to time the market, because if you think the market is going to come down another 5 or 10%, maybe it does, maybe it doesn't. But once things change, picture this: federal government starts getting inflation under control. Everybody starts thinking federal government's going to lower federal funds rate, which will hopefully lower the mortgage rates. Once that happens, it's going to happen really quick, and people are going to jump in right away, and you're going to miss that opportunity because everybody's going to be back into the market. So I can tell you from history, things change very, very quickly on the upside. At least that's been my experience. I've been doing this for 18 years. And if you're a seller or one of my clients watching this video, there's a few things to keep in mind. Number one, I never try to push anybody to sell property. You have to sell property when it is right for you. There's certain things that we need to discuss if we haven't yet, or if you're thinking about selling. One of them is, what is your cost of carry on the apartment? What is your true cost of carry? What is the cost of capital tied into that apartment? There's an analysis there that we could have. So number one, we should do that. And number two, you have to think about, when do you think the economy will turn around? When do you think property prices will rise? When do you think the volume of transactions will increase? And your bet on that, in conjunction with your costs of carry, are things that would factor into that decision. One other thing is, if you're looking to upgrade, it's an amazing time to upgrade, because you might not sell for as much as you'd like to today, but the property that you will buy, you will get a substantial discount on as well, and you will be in a net positive territory. And lastly, for those that are afraid to purchase because of rates, I've said this before, I'll say it again, and you've seen on all the charts I've shown here today, rates fluctuate. Buy the apartment, marry the apartment, but date the rate. You can always refinance when rates get adjusted in the future. And nobody can make any prediction, but you've seen what they've been in the past. You've seen how they've gone up and down. So that's really something you have to wait and see. If you have any questions at all, if you'd like to discuss your apartment in specific, your building, your neighborhood, I'd love to delve in with you. If you're thinking about buying, we have great, amazing properties to show you. Plenty are going into contract. It's just a matter of whether you have the opportunity and the luck to get one of our beautiful properties. Thanks so much, and I hope to hear from you if you have any questions. As always, please feel free to share this with anybody who you know is interested in the real estate market in New York City. Thank you.